At BMO ETFs, all our investment tickers start with Z. That's right, Z, not Z. From ZSP to ZEB, we build solutions for the Canadian investor. So next time you invest, consider a Z instead.
Hey everybody, it's Larry Berman here. Quick and dirty this week. Not a lot changed last week. The market continues to be supported by more optimistic headlines coming out of the White House on trade, notwithstanding all the other stuff that's coming out of the White House these days. It was a volatile week in that sense, to be sure. But the bottom line is higher highs and higher lows is a big, a real big part of the short-term tape here and support for U.S. equity markets. We heard late Friday that U.S. was sending a trade team to London to meet with China. So, you know, we'll hear on Monday on how that goes. But to us, there's still far more economic headwinds, including a continued weakening in the U.S. labor picture. To the extent that support for rate cuts is a positive, but the reality is a weakening U.S. labor situation is kind of the last piece of the economy really starting to soften, and then earnings obviously behind that. Anyways, let's take a quick dive into the chart room and see what the charts are telling us. Okay, so on the labor side here, U.S. non-farm payrolls came a bit higher than the whisper number, but it was this revision in the past couple of months of 95,000, bringing the 3-month average of payrolls, down. Well, up from last month, still down to the lowest level in about a year. When we look at the composition, average hourly earnings are up significantly. But when we look at the participation rate, we saw a big drop out of the U.S. labor force, and we actually saw on the household survey about 580 odd thousand job loss. And so that household survey swings wildly. The vast majority of job gains are coming from the birth-death model, and that is the estimate of new businesses starting relative to businesses going out of business and what those jobs are bringing to the economy. The concentration of jobs continues to be in healthcare and leisure, supporting the aging demographic, and not really, the growing, the middle class, the 25 to 55 year old economy. And to us, it's that part that's most sensitive for a successful, robust, economic growth, and not the fringes that we're seeing where the growth is maintaining now. The people with money continue to spend, etc. So we think it's weakening. Equity markets don't seem to care what we think these days. So when we look at the S&P 500, week over week, we see a grind higher, we see higher lows, we see higher highs every day. And so until the trend breaks, and to us, the 200-day average that held on the last little dip, which was the resistance on the initial rally after we broke in February, we need to take out that to really get the bearish juices flowing again, and we'll see whether that happens or not going ahead. So at this point, it looks like it's possible to grind up to the old highs. We'll see what happens on the trade picture, but we're, every week that goes by, we're getting closer to that July 4th, where we need the big, beautiful bill signed. We need the continuing resolution passed in a better form than it is today with the Senate. And all that sort of translates into, what's going on in the bond market here. So when we look at TLT, we saw the weakening continue claims for a couple weeks. But the bond market gave back a lot of those gains on the weak ADP and the weak continuing claims this week when we saw the headline employment number. But the trend here is more oversold, and I suspect the bond market's going to hold in here pending what we see ultimately as the debt financing needs. Once the debt ceiling is raised and we get the next quarterly refunding announcement in a few months from now, what the plan is to pay for all this new spending as they raise the debt ceiling and replenish the Treasury General account. So there's still a lot of bond pressure out there. It just doesn't support the bond market rallying in a big way here. And so that should matter at some point for the multiple expansion that we've seen in recent weeks that's really been supported by presidential social media posting, not real fundamentals in my mind. Anyways, that's the picture as we see it. Like it or leave it. I just can't get overly confident about the equity market rally here, and maybe that's to my detriment at the moment.